2024 has been a good year for stocks so far, but the S&P 500 and the Dow Jones Industrial Average won't stay this strong forever, which is why investors may want to consider a category that comes with guaranteed income regardless of the market's ups and downs: dividend stocks. Investment advisors emphasize the importance of diversifying your portfolio with stocks from different market sectors. If small-cap stocks are up one year, the emerging market sector might be hot the next, or large-cap stocks, or high-yield bonds, or any other asset class from real estate to gold. Diversifying your holdings means you're more likely to profit from the next big thing on its way up. It also helps to limit your losses, especially during market downturns. And that's where dividend stocks can help. Dividend stocks are shares of companies that return a portion of their profits to shareholders by making regular payments called dividends. You can choose to reinvest that money in new shares, or you can cash it out as income. Most dividends from stocks are taxed at a lower rate than regular income, from 0 to a max of 20%, making them a low-tax income source, especially for retirees. Dividend stocks are often called stocks that work like bonds. That's not technically true because bonds work like loans that pay you back interest, while dividend stocks are shares in a company that pays out profit in the form of dividends. However, bonds and dividend stocks have some common elements, most notably the regular cash payments. Also, dividend stocks, just like bonds, tend to drop less drastically during market downturns. Combined with the regular payments, these stocks can offer income with a more stable share price during market downturns. Let's look at an example of a dividend stock and how it's behaved during a time of great market turmoil. You may know Target as a popular department store, but it also happens to be a popular dividend stock. In 2008, during the early days of the Great Recession, Target lost 30%, compared with a 39% loss for the S&P 500. In 2009, Target rose 40%, while the S&P 500 rose about 24%. So this shows that during the Great Recession, Target stock fell less and recovered faster than the rest of the market. During that time, Target also increased its dividend each year, which means that investors also received regular payments during the Great Recession, which actually kept going up instead of down. Target belongs to a group of stocks classified as dividend aristocrats. These are shares of companies that have raised the dividend paid on their stock for 25 years in a row or longer. Right now, the S&P 500 Dividend Aristocrats Index includes more than 60 companies, such as Sherwin-Williams, Caterpillar, and Automatic Data Processing, which is the payroll processor better known as ADP. There are a number of ETFs and mutual funds following the index, or slicing and dicing the index to highlight certain characteristics, such as high-yield dividend funds. On the flip side, in a strong market, dividend stocks might not rise as fast as the rest of the market. For example, the S&P 500 has far outpaced the Dividend Aristocrats Fund. But at the same time, the S&P is powered by the Magnificent Seven mega-cap technology stocks. One misstep at Meta or Nvidia, and the entire 500 stock index could take a hit. Dividend stocks, by comparison, aren't high flyers, but established companies with stable finances that can offer a steady stream of dividends and a less volatile stock price. Here's the bottom line. If you're hoping to diversify your portfolio and are looking for alternatives to the high-powered tech stocks that dominate the news cycle, you may want to take a look at shares of companies that provide income and stability. In that case, dividend stocks could be an option for you to consider. As always, do your own research and don't hesitate to reach out to a financial advisor if you need help diving into the details. And if you want more content like this from MarketWatch and the Explainomics playlist, please subscribe and keep checking back for new videos. And we'll see you next time.